This is Liberation Day. I will sign a historic executive order instituting reciprocal tariffs. China, 67%. We're going to be charging a discounted reciprocal tariff of 34%. European Union, they're very tough. We're going to charge them 20%. Taiwan, we're going to charge them 32%. Japan, we're charging them 24%. We will impose a 25% tariff on all foreign-made automobiles. We will establish a minimum baseline tariff of 10%. Promises made, promises kept.
And that was President Donald Trump detailing his plan to impose the steepest American tariffs in a century. Stock set to wipe out nearly $2 trillion in market value with 30 minutes until the start of the official cash trade. Here's the message from markets. Let's go right to the S&P 500, down 3.7%, set to open back in correction territory and then some. It's even worse if you take a look at big tech. Of course, the Magnificent Seven very exposed to that global manufacturing supply chain. The NASDAQ 100 down 4.5% and the VIX rising, now trading with a 27 handle. That is the U.S. reaction. Let's take a look cross-asset and globally as well, because you have the stocks down over 2%, the FTSE 100 down about 1.4%. Clearly, it's the American markets that are bearing the brunt of this sell-off. You take a look at what's going on with currencies, and of course, the bond market isn't up here, but I'm telling you right now that yields also dropping as investors seek a haven. So there's a lot of red on this screen behind me, Chanel. I know there's even more red behind you.
That 10-year almost at 4%, stunning all around, stunning in the pre-market movers as well. We look at individual stocks. Apple down pre-market to the tune of 7.6%. Remember, they produce all of the iPhone parts in China. They're not even the only ones down. Of course, most of the Magnificent Seven really hurting this morning. Nike also down almost 15% at the market open, and they're just among all the retailers falling after increasing their reliance on factories in Vietnam, Indonesia. We're looking at Restoration Hardware also dropping to the tune of nearly 33% pre-market, because not only did their earnings projections miss estimates, the shares are also plunging on tariff uncertainty. And remember, a lot of the countries where parts are sourced from, or apparel is sourced from, are facing reciprocal tariffs of double-digit percentage points or more. Now, Commerce Secretary Howard Lutnick just joined Bloomberg TV, and he spoke on the importance of bringing American activity back to American soil.
CEOs are thinking about is finally, let's think about building in America. You've got almost $5 trillion of commitments coming to America to build their factories. That number's only going to grow as people realize it's time to bring manufacturing home to America, where the greatest economy and the greatest market in the world is. It's time for America to stop taking care of every other economy in the world and building them up. Let's build the American economy up. Let's build American GDP, and you're going to see great growth from America.
I'm Katie Greifeld alongside Sonali Basak. Matt Miller is off today. Welcome to a special edition of Open Interest. Let's get all those details about the timing and the scope of these tariffs. We'll go to D.C. and Bloomberg's Akayla Gardner. And Akayla, you take a look at the reaction from markets, from strategists, from economists. It seems like the consensus is this is much worse than expected.
Yeah, well, these are the worst and steepest tariffs that we've seen the U.S. impose in more than a century. Some of the biggest hit countries were China, the EU, Japan, but we're seeing a 10% baseline going into effect on Saturday. That is notable because they were expected to go into effect today, Wednesday at 12:01 a.m., and now they're being delayed. Certainly leaves room for negotiations, and we just heard Secretary of Commerce Howard Lutnick saying that they're already starting to have these conversations. He said the president is willing to take calls. And we did get a reaction from the president just moments ago. He posted on Truth Social. I'll read it to you. It says, "The operation is over. The patient lived and is healing." Seemingly in reference to the stock market reaction that we're seeing. We saw the White House telegraph before this happened that they knew that there would be a stock market reaction, but they say this is just a moment in time and they're looking long term.
Akayla, we thank you so much for the latest. That is Akayla Gardner in D.C. Of course, we're hearing from more members of the administration. Scott Bessent last night, Howard Lutnick this morning. Now, countries outside of the United States, they're, of course, vowing now retaliation for Trump's sudden barrage of tariffs. We're going to bring in Bloomberg's Oliver Kirk, watching closely from Brussels. What are the most immediate reactions and the ones that we are waiting for?
Yeah, the first thing to say is that this sort of reaction, the sort of actual figure, the 20% on the EU, is basically at the higher end of the range of what the EU policymakers were expecting. They were expecting something between 10 and 25%. They got 20%. And we heard from Ursula von der Leyen, the president of the European Commission, a little earlier this morning, saying that basically they're going to take a bit of a wait-and-see approach. They're going to sort of assess what this really looks like, and then they're going to talk about it with their trade ministers starting on Monday. That being said, I think that what all of these sort of policymakers here in Europe and probably around the world and scratching their head a little bit is basically how do you equivocate the sort of tariff rate to these non-tariff barriers to trade that the Trump administration keeps talking about, and Howard Lutnick is basically saying is the main thing they're trying to resolve with these tariffs. How do you basically say, 1% tariff rate versus, say, a VAT tax, these sorts of things? These are the things they're going to have to try to equivocate over the next couple of weeks. And we should say that already we have heard from the German economy minister, Robert Habeck, who basically likened these tariff increases to basically having as much economic impact as Russia's invasion on Ukraine on the European market. We've heard from the French, who also want to take a much more aggressive approach. So for the Europeans, it's going to be about building consensus, which is going to be pretty challenging as the sort of stresses rise. And we've already got the companies across the world, Volkswagen, talking about raising prices in the U.S. already. It's already happening.
Yeah, just to meditate a little bit on what the German vice chancellor said specifically, last night's decision is comparable to the war of aggression against Ukraine, and as such, the magnitude and determination of the response must be commensurate. Oliver Crook, we appreciate your reporting. Joining us at the desk to discuss the market reaction, I'm pleased to say we have Morgan Stanley Chief U.S. Strategist and Chief Investment Officer Mike Wilson. What a day to have you in studio with us.
A lot of fun. Let's get into it.
So it's interesting. I mean, I take a look at the S&P 500 down nearly 4% in the pre-market, and I've seen a lot of notes to the effect of they're surprised that it's not down even more. Neil Dutta from Renaissance Macro, chief among that chorus, saying that it could be a lot worse. But what do you make of the current drawdown? Because it looks pretty ugly from where I'm sitting.
Well, first, let's level set on what was announced. Okay, it was at the kind of more bearish, hawkish end of what we were expecting. So that's a negative surprise. We've been using this 5,500 level all for the first half, and this is the third attempt now. So the question is the third attempt the charm to kind of go through that level? Right now, the market, I think that's why it's not down as much, because the market's testing. It's doing what it always does. It's going back to the old lows, at least at the S&P level. Now, if you look at underneath, like some of these apparel stocks and consumer, I mean, they're going on a lot more. So I think, as usual, the market is trying to be more prescriptive with the impact of which sectors, which stocks are going to hit the worst, and which areas perhaps could be less affected. Quite frankly, I'm a little surprised that areas like Japan or Europe aren't down more, because as the adage goes, if the U.S. is going to have a slowdown, other regions probably are going to be worse. Part of that, I think, is just the story of watch the currencies, right? So there's a little bit of capital flight, and it has been all year, where money is being repatriated back to those regions, and that's really the offset. But if the dollar and other currencies were to stabilize, then you would probably see more price degradation in the foreign markets.
I'm going to go back to your apparel comment, and I'm going to do so by showing the White House statement on how they got to some of these rates. It's a pretty wild equation. We're looking at it right now, and basically what they're doing here is dividing a country's trade surplus and dividing it by the U.S. total exports and dividing that number by 2. So what does that get you to? It gets you to levies of more than 40% and 30% on places like Sri Lanka and Bangladesh, places where all this apparel is coming from. Mike, wasn't that just a factor here of exporting cheap labor to these countries in the first place? I mean, is there something that is going to really tear apart these supply chains by those kinds of levies?
Well, first of all, that formula is a bit arbitrary, right? That is probably a little confusion and just, suspect sort of nature of it. But that's the point. They're using that so they could be more aggressive here. I mean, it's crystal clear that what they want to do is they want to be very aggressive with the initial salvo so that countries know that they're serious. And their attempt to get them to come to the table and now have a negotiation. Not all countries are going to engage in that, of course. This is going to be very messy. And that was all part of our thesis this year, which is the first half is going to continue to be this very uncertain, very messy sort of setup. Not to mention all the other things that have been going on in the background, other policy changes, the stuff that's going on with AI CapEx, right? The Fed is no longer being as dovish. these are just as big a factors to me as the tariff announcement. But when you put them all together, boy, it's a lot to digest.
Well, I want to go to the daisy chain there because, you mentioned you have all these other factors as well. But you think about the Fed, you think about the economy. It feels like a lot of this is predicated on what happens with the global trade picture. I mean, you think about the Fed. The Fed, others would argue that they aren't. But there's this idea out there that the Fed is in a bind because, the expectation is that inflation is going to go higher, growth is going to slow, and the Fed is kind of hostage to that.
Well, let's talk about that because that, to me, is a relief valve. If the Fed were to get more dovish, that would definitely help asset prices. But to your point, they've been a bit more hawkish around this idea that, hey, tariffs are inflationary in the short term. Maybe it's transitory in the long term, but we have to respect that, okay? In fact, our economists took their rate cut out for June. Now, the market isn't there. I think if the market actually believed that the Fed was on hold for the rest of the year, we would definitely go through 5,500 pretty cleanly. So the market isn't there. The market's pricing in 3.5 cuts this year so far. They believe the Fed will be there if things get worse first.
It's interesting. I mean, you mentioned your economist taking out that June rate cut. You had Neil Dutta. I keep bringing him up.
4 cuts.
4 cuts this year that the Fed is going to basically care more about the growth picture than inflation.
One thing, Mike, a rival of yours this morning was telling me that what they are worried now about is what they believe is the most nightmare scenario. You had the same comment from Jim Zelter this morning at Apollo, stagflation. Yeah. Do you think that's the scenario we're looking at now?
I don't think we're looking at stagflation. I mean, first we have to define stagflation. When the problem is when you use that word, they think, oh my God, 1970s, and we're not going to have double-digit inflation with negative growth. I mean, I don't think that's where we're going. But is it in the directionally? Yes. So higher inflation, stickier inflation, and worse growth. That was actually our view coming into this year. I think we've priced a good chunk of that. Once again, I come back to the Fed. Does this keep the Fed hostage, as Katie was saying? Maybe. And I think if the market starts to believe that they can't act if growth is worse or credit markets or funding markets get unwieldy, then, yeah, I mean, equity prices are wrong. They're going to go lower.
Mike, you are sticking with us. That is a good place to kick off the show. Mike Wilson sticking through the opening bells. Now coming up, we're going to give you a read on big tech's reaction to the Trump tariffs. We're going to bring in Stefan Slowinski of BNP Paribas Exane next.
Plus, more from Commerce Secretary Howard Lutnick. Let's take a listen.
We really need to change the way trade works around the world. It's tariffs, but don't get confused that these non-tariff trade barriers, they are the monster that needs to be slayed.
Well, let's take a look at the Magnificent Seven because Microsoft, Meta, Apple, Nvidia, Tesla, Google, and Amazon all in the red this morning. Let's unpack it now with Stefan Slowinski. He is Global Head of Software Research over at BNP Paribas Exane. And I saw this note from Goldman basically laying out that you think about the Magnificent Seven driving nearly half of its revenue from outside the U.S. That makes them among the most exposed to these global growth risks. What does that mean in the context of the decline that we're already seeing in these names? How much worse could it get?
Yeah, good morning. Thanks for having me on. You're absolutely right. The Magnificent Seven, the large cap tech names, they are the most mature. They are the most global. They have more than 50% of their revenues from outside of the U.S. Obviously, a weaker dollar helps a bit, but the tariffs will impact them. Obviously, more on the hardware side than the software side, and that's what we're seeing getting reflected today in shares of Apple and other hardware names where those tariffs have more of a direct impact. On the software side, you are more protected. Most of the software companies obviously don't manufacture, they don't import, and they also don't do any business in China, so there's no impact there. But we're seeing more of a pressure there on valuations. We did publish today our BNP Paribas software technologists looking at valuations across the sector. Valuations are kind of in line with kind of historic averages right now, but we still do think you could see 15% downside on some valuations if we continue to see multiples compress towards the lower end of their historic ranges.
15%. Now, one thing I can't understand is why is it, Stefan, that at this juncture, so many analysts, investors are only looking at the input costs, where these big tech giants source their materials from, for example? Because if you are Amazon, right, or if you are Apple, then don't you have to start worrying about consumers? If you're even Microsoft, don't you have to worry about B2B spending slowing down?
Yeah, absolutely. There's lots of cross currents, right? So you said there's the direct impact in terms of the manufacturing and tariffs. There's the indirect impact of consumers and enterprises slowing their own spend, and that's going to potentially hit earnings. You also have a potential indirect impact from, you could potentially see boycotts of U.S. goods on the consumer side, but we're even seeing on the enterprise side some governments pushing their own companies to shun U.S. technology. Obviously, there's not a lot of other options out there for some of this technology, but all these things are headwinds that investors are grappling with today.
Stefan Slowinski of BNP Paribas Exane, we thank you so much for breaking that down for us. We are back now with Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. Let's marinate on that for a minute, because if you are worried about input costs, that's the first order effect. Right. How worried about the second order effects are you?
Yeah, so the 5,500 was based exactly on the first order effects, which is it's a 5 to 7% hit to earnings, and that gets you to kind of that level. The second order effects are confidence. Do we get a layoff cycle? Do private companies stop investing completely? Is there a freeze on activity? And that's, sub 5,000. That's a recession, basically. That's the market going to the recession call. The hard data is held up. We'll see. As I like to say, the hard data for the economy is held up. However, the hard data for earnings have not been holding up. Right? We've been very clear about that. And so, once again, like we've been saying this, we think it's very unlikely you have any chance of making a new high in the first half of the year, as before last night, until revisions turn up. And that is not likely until the second half of the year, even if, let's say, negotiations go well, we kind of work through this tariff issue and maybe the downside is only 5 to 7%. Until we get clarity on that, companies are going to sound probably much more bearish about their outlook, because why not take the bar down? Mm-hmm. So that's what I'm most worried about now, is that in the first quarter earnings season, companies are going to just say, hey, let's just be conservative here. Why not? Let's lower the bar. Then the revision factors go even lower, and then all of a sudden the market starts thinking about 0% growth. Okay, that's the chain effect here that we're thinking about. And I think when I was on last week or 2 weeks ago, I said I thought that maybe this event could be relief, but ultimately we still got to get through earnings season. So obviously this wasn't relief. This was the opposite. This is really more of a sell the news as opposed to buy the news. And now we're going to chop around, I think, until earnings season. Then we'll get more clarity.
So until we get that clarity, I want to talk a little bit more about input costs, and I want to talk specifically about AI, because AI has been the story, or had been the story, up until we got DeepSeek a couple of months ago at this point. A really interesting note from Peter Cheer over at Academy Securities, saying that you think about the 32% tariffs on Taiwan. Taiwan is where a lot of our most important chips are made, and his view is that AI just got a lot more expensive, at least in the U.S. There were already fears forming over the CapEx story that has been the tailwind to this market, and I feel like it just got a little bit darker.
Yeah, I mean, it definitely doesn't help. But let's recall that semiconductors have been, maybe other than autos, the worst performing sector for the last 8 months. Okay, they peaked in the summer of last summer, and that's been a function of, I think, this constant calling of the bottom that has just not been there. That's a demand problem. It has nothing to do with tariffs, nothing to do with where things are being manufactured. And of course, AI kind of kept things propped up. So we've been underweight, semiconductors versus software for 8 or 9 months, and this is just another kind of reason why we're not going to see a recovery in that space. So once again, I think that the market, as usual, has figured this out. It's been trading poorly for a while, internally and at the index level for 3 or 4 months. Tariffs is something that is galvanizing. It's controversial. Like, why are we doing this? The plan. Everybody's arguing about why we're doing it, how we're doing it, et cetera. That's messy. That's policy. Policy making is messy. And remember, in any administration, you come in, you do the policy, you see how the market reacts, and then you adjust. The Fed does the same thing. So that's how I'm viewing this. They're gonna watch the market today. They're gonna watch the response from the trading partners, and then they'll adjust how they're going to implement it.
I want to pull up some headlines for you, too, to speak to what you're saying here, Katie. You have Microsoft pulling back on data centers from Chicago to Jakarta, halting or delaying projects. Then also from the information, NVIDIA facing a big dilemma. Chinese firms rushing to order 16 billion in new chips that now they have to struggle to try to meet that demand for, to get ahead of. And also, I'm looking at the banks here this morning, too, because they're dropping as well as people start to get more and more about what you started to say about those recession odds. Mike, what are your recession odds?
Well, our economists have that number. It's probably 30-35% in their mind. It's gone up from 20. I think if I talk to clients, it's probably close to 50. And then some clients are, even higher than that. And then there are people who are still holding out saying, well, we can muddle through here. We don't know. I mean, let's be honest. I mean, the curve, just to be clear, the bond market and the curve is not as recessionary as it was last summer. So this has been one thing that's been kind of absent in that storyline. Stocks have been trading very defensively. That's how we came into this year. Defenses over cyclicals. That has been portraying a much more high recession likelihood than the bond market. Now, maybe that changes today over the next week, but that's what we'll be watching. We'll be watching how is the bond market trading? Is the 2-year really coming in hard and putting pressure on the Fed, saying, hey, you guys are way behind the curve again, like last summer, which then got the Fed to do what? Cut 100 basis points.
Right.
So the Fed does watch the bond market, they watch credit markets, they watch funding markets. And that's the other thing that could happen here that could get the Fed to really come off. It doesn't have to be a recession. It could just, or even a labor cycle. It could just be the credit markets, funding markets start acting poorly, and the bond market screams at them with the 2-year plummeting, saying you guys are behind. So those are the things we'll be watching over the next 2 weeks. Earnings revisions, labor market data, and then credit and funding markets.
Well, Mike Wilson, I'm thrilled to say that you are staying with us through the opening bell, which we will get to next. We have just a few minutes to go, and I will note that the 10-year Treasury yield still holding above 4%, but getting very close. You take a look at the S&P 500, now down 3.8%, not quite cracking that 4% level, but we'll keep a close eye on that next. This is Open Interest. Welcome back to Open Interest, to check on futures ahead of the opening bell. This is your setup. You have the S&P 500 down 3.6% in the pre-market. Where is the pain coming from? Everywhere, but mostly from big tech, because the NASDAQ 100 down about 4.3% right now. The Magnificent Seven really in the hot seat as we consider the input costs heading into our Magnificent Seven. And then the small caps, theoretically less exposed, but still the Russell 2000 down almost 5%. We'll walk you through all of the action coming up next. This is Open Interest. We are moments away from the start of trading on what's shaping up to be pretty terrible Thursday. Welcome back to Open Interest. I'm Katie Greifeld. You're taking a look at the reaction to President Trump announcing the highest American tariffs in a century. The S&P 500 down about 3.5% in the seconds before the bells officially ring and open this market. Of course, we're going to open, I believe, in correction territory, erasing 3 days of gains. It's a similar story if you take a look at all the other big benchmarks as well. I do want to point out that Newsmax is ringing the bell down at the New York Stock Exchange, closing 77% lower yesterday, down another 14% or so today, but still up several 100% so far. But the focus today, of course, is on the fallout. So we're going to do something special here. Let's break down the movers sector by sector, and we start with big tech, among the hardest hit. Bloomberg's Emily Grafeo is taking a look.
That's right, Katie. And within technology, one of the stocks getting hit the hardest is Apple. Their manufacturing and supply chain seen really getting hit here from the tariffs. The iPhone maker is one of the firms most exposed to that tariff risk. The new reciprocal tariffs will reach 34% for China, bringing the total rate on Chinese goods to 54%. You look at what the street is saying. Bloomberg Intelligence said the new tariffs will likely squeeze Apple's margins, given they don't expect the company to hike prices to offset the effects of the tariffs. Interesting from Jefferies and a couple other names out there saying this, the base case remains Apple will be exempted from the China tariff. So that is something to watch, but nevertheless, that stock down. And other tech names down as well. Nvidia, Amazon, and Google, everything that was really driving the market higher a couple months ago is now really getting hit.
And it brings the year-to-date declines to a pretty significant place. Emily Grafeo, we thank you so very much. Now, the auto sector is already responding to Trump's tariffs with supply chain changes and price changes as well. Bloomberg's Nora Melinda is looking at the sector.
Well, Sonali, it's a really brutal day out here as we're looking at auto stocks. I've got eyes on Ford, GM, Stellantis, and Tesla. We're seeing a lot of these German automakers starting to actually figure out what they want to do. Do they need to move to the United States and start doing their production here? But nonetheless, we're hearing a lot of big names in Germany. They're saying that with German automakers being some of the most hardest hit, they're saying that this is just bad for the U.S. consumer. It's going to rise inflation. And so we have a lot of these companies like Volkswagen, Mercedes-Benz, and a few others that are scrambling to figure out what to do here. Tesla, of course, we know this to be a big Mag 7 name. It is one of the biggest decliners today as we're looking at everything here on Wall Street. But not great news here, especially with Tesla seeing a 62% sales plunge in terms of last quarter in Germany.
All right, Nora, thank you so much. That is Bloomberg's Nora Melinda with a look at the autos. I do want to point out Nike falling about 11% right now, hitting its lowest level since 2017. Bloomberg's Isabel Lee, tell me about what's going on with those retailers.
It's not looking good here also with the retailers. We have European sneakers, clothing, and jewelry really taking a hit. Nike, for instance, to your point, it's now edging lower by 13%. They've increased their reliance on factories outside of China to Vietnam and Indonesia after President Trump's first term, when he said he's moving away from China. And now Nike produces 50% of their goods in Vietnam. And while now the U.S. is imposing reciprocal tariffs of 46% in Vietnam and 32% in Indonesia. And really, sports companies will struggle on how to find a better place of production, and they may just pass on the cost to consumers. Lululemon also produces around 40% of their goods in Vietnam, and you see shares also edging lower double digits. And RH shares, it tumbled 26% in pre-market trading. It's now down even lower by 35%. We have the luxury home furnishing company reporting earnings that really was underestimated and below Wall Street's expectations. And we have analysts noting that the new round of tariffs will significantly add more uncertainty.
Bloomberg's Isabel Lee, we thank you so very much. And still with us now, Morgan Stanley Chief U.S. Equity Strategist Mike Wilson. We have taken out your low. We are below that 5,500 level on the S&P 500. So what is the new low to look for as traders try to assess here the bottom line, where they can finally get back in with some comfort?
Yeah, I mean, we're technicians. I mean, we definitely use that. It's worked well for us. I mean, the 5,500 we put out before we got there, it was support, but now it may be resistance. So what we're watching for today, if the cash market makes new lows, which looks like it is, and we kind of stay there, the next levels are low 5,000. So at 51, 5,200, we probably can get there fairly quickly, probably through earnings season, and then we'll see again. Okay, the real support, okay, like the longer term support is 200-week moving average. That's like 4,700. But it's rising. Okay, so it's a timing question. Now, do we have to go to the 200-week moving average? Well, look, if it's a recession, we're definitely going to that level. So I just want to put that in people's minds. That's kind of, if it's a hard landing, we're going to trade between 4,500 and 5,000. I mean, pretty quickly. Okay, and markets tend to want to go there. Obviously, it's not doing it today, but things can change quickly. We're in fast-moving markets. And I guess the advice to people is, it's fast-moving markets, so that means unless you know what you should be trading these unless you're a professional, right? There are things you should be rotating out of potentially that maybe you have too much exposure. That's what we were doing earlier in the year. I just want to put this out again. We were very defensively positioned at the beginning of the year. Like our portfolio is up 14% relative to the S&P.
Right.
That's pretty extreme. And what I'm saying is, I'm not bragging about it. What I'm saying is, like, it's kind of happened.
Right.
So you have to be a little bit on alert. Like, you don't want to be the person pressing on the trade that has already worked so much. Like, for example, consumer discretionary. We've been underweight this for 2 or 3 years. I mean, these stocks are getting hit really hard again. Then you look at something like autos; those stocks are down less than the S&P, that's what we're going to be watching over the next few days. Like, what areas that have already been pummeled are now actually maybe not going down as much as the market, and those are areas for longs. And of course, areas to be underweight or relieving are areas that have not corrected enough yet and are now going down even more.
I just want to go back to 4,700. That is the 200-week moving average?
Roughly, yeah.
So draw that on your charts. That's a level to look out for. We were talking a little bit in the break. You mentioned defensives, and it's notable that gold has been having a really tough time, even as you see bonds rally. And I want to get your thoughts, and we talked about this a little bit already, but what are the hallmarks of a disorderly sell-off? The narrative so far has been this is pretty much proceeded as usual, no panic here, but what would disorder look like in this market?
Well, I talked about it already. I think credit markets and funding markets would be something that would get the Fed's attention as well. Like if you start to see those markets trade in a, disorderly or just, not the way they've been trading, which is pretty solid. That's, I think, warning number one. Gold is an interesting asset, right? I mean, it's been a spectacular asset, not just this year. It's been a spectacular asset for 25 years. I mean, I would like to point this out to people. Gold has outperformed the S&P 500 by almost 100% over the last 25 years. It's a little known fact. The risk for gold, something like that, which is a safe haven asset, is that's what you sell when you need to sell something. So we're definitely not there. Like, for example, in COVID, if you remember in COVID when we had the final collapse, gold went down as much as the stock market. Why? Because that's what you sell what you can, not necessarily what you want to. We're not. That's not where we are. Okay. But those are the things you need to be watching for. That would, by the way, that would make me bullish if you saw liquidation like that.
Yeah.
We're not seeing that action this morning.
No, I'll point out, Sonali, you take a look at investment grade credit spreads. You do see measures of risk rising in the corporate credit market, but investment grade spreads are still below 100 basis points. That certainly feels out of step with what we're seeing in the stock market today.
Yeah, and I think about like the Mark Lasry trade, the JP Morgan trade going into this was, say, buy Ford bonds because you're not worried about Ford going underwater, but you can buy the bonds cheap. Let's see if that holds. But one thing I'm wondering about is how much volatility is ahead, given the tariffs, and also given, by the way, snuck in there yesterday, you had Treasury Secretary Scott Bessent giving a warning on the X date. We have to remember that those tax negotiations are also going on at the same time we're approaching a debt limit. And if you're worried about credit markets and Treasury markets and funding markets, isn't that a problem?
Well, this is why they're pushing it now, right? I mean, they're doing a lot at once. I've likened, this administration like to a new CEO coming in and just saying, you know what, let's do all the things that we want to get done fast, restructure things, and then hopefully our plan will then play through into next year. If we were talking about a stock right now, how would we be talking about this? We'd be saying, oh, there's a restructuring, there's a vision. I think people just aren't there yet with the vision, but that's what they're trying to communicate. And I think, the X date is just that's another way for them to get what they really want to do. I mean, Scott Bessent's been very clear. The TCJA extension is critical. Otherwise, you definitely are going to have a recession, right? If you don't get an extension on tax cuts, the fiscal drag on that's going to be dramatic. So that's why they're very focused. They're using some of this tension in markets right now to perhaps get some of their policy done, which requires legislative approval. It's messy. It's policy making, right? This is Washington at its best or whatever, right?
Yeah, I love the idea of thinking about basically if this was a stock, what would we be saying? I'd be saying, what does the board think? I can't wait to listen to the earnings call and hear the analyst questions. Mike, we have to leave it there. You've been so generous with your time this morning. Really appreciate it. That is Morgan Stanley's Mike Wilson. Now, coming up, Trump slaps Vietnam with a 46% tariff rate, which could soon impact price tags for many top brands. We'll take a look at the sell-off in retail stocks next. This is Open Interest. Welcome back to Open Interest. A quick check on stocks. 13 minutes into the session, I just want to show that the S&P 500 loss is lessening right now. The S&P 500 down about 3.2%. Remember, we were close to a 4% drawdown in the pre-market, so we'll continue to keep an eye on that one. But it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Bank of America double downgrading Lyft to a sell as its rival Waymo expands in California. Next up, we have NVIDIA getting cut to a hold over at HSBC, which sees limited upside potential for the AI-focused chipmaker. And finally, BJ's Wholesale is getting raised to a buy over at Citi. Analysts say that actually it's a relative winner when it comes to the tariffs. And you also have Citi cutting Best Buy and Restoration Hardware on rising recession risk and slowing consumer spending. Of course, Sonali, we got a real-time reaction to the tariffs from the RH CEO last night, but I don't think I can say that on air.
Certainly. We will talk more about that. We're going to stick with retail, that sector taking a big hit from those newly unveiled tariffs. There are a lot of these companies that are particularly exposed to high levels on Vietnam and China. We're going to bring in Bloomberg's Romaine Bostic to take us through what's happening with the sell-off. And you spoke to at least the Citi analysts, I know for sure here. Yeah. What is the read-through on what might not be immediately obvious to investors here?
Well, I think a lot of people just got a little bit caught by surprise, Sonali, in terms of the scale and scope of the tariffs, particularly when it comes to the retail space, where a lot of these companies, of course, still source a lot of their materials from overseas. Let's take Best Buy, for example. One of the parts of the downgrade that we saw from Stephen Zacone over at Citi. We're talking about a company that sources more than 60% from its external suppliers are from overseas here. And this is a big part of the reason why you saw the stock open lower, in fact, down the most going back to 2020, basically the onset of the pandemic back in March of 2020. You take a look at the XRT, the Spider Retail ETF, that opened in bear market territory, the worst day, at least so far, going back to 2022. And you can go through the numbers and you look at the exposure. You have companies like Five Below, 44% of their sourcing from suppliers from outside the U.S. Target, 54%. Walmart, 58%. Oxford Industries, that's Tommy Bahama, 64%. Nike, 66%. And Contour Brands, that's Wrangler. I know you're a big fan of Wrangler, Sonali. 83% of their suppliers sourced from overseas.
Yeah, it's pretty dramatic when you start to calculate all the input costs. But something that we've been talking about, and we had this conversation with Joe Feldman from Telsey yesterday, that it's kind of a double whammy because you think about how much more expensive it's going to be to source those materials, but then you think about the consumer on the other side who has to buy these things.
And this is the big issue. And you mentioned RH. We should just point out Gary Freeman, CEO, used some very colorful language on the conference call. That was a conference call that was taking place while the president was speaking. So they had to address this. And I will give you the family-friendly version of what he said, which was, we were surprised. He used a curse word in saying that. He said, quote, "We thought we saw it all until today." So this is a new one. He did also say, though, Katie, that he doesn't necessarily think the tariffs would stick, but he raised a lot of concerns about economic conditions. And that's a big part of the reason why you saw some analyst upgrades in the discount space. Think TJX, BJ's Wholesale, the idea that if there is an economic slowdown, those names would do better.
You know, Romain, this is a lesson I learned from you. You can say anything on TV once.
Yeah, you may not have a job the next day, but, you know, look, I think the fact, and RH, we should point out, RH has always been very colorful in talking about macro and economic conditions, so that wasn't really unusual. I think it will be interesting to see what we hear from some of these other CEOs and C-suite executives, whether they articulate the potential pain in the same way that we heard from Friedman. Right now, we're just talking about an industry that tried to sort of adjust to those big tariffs that we saw back in 2017, 2018, pivoting away from China. You had Isabel Lee talking a little bit earlier about that pivot to Vietnam, about that pivot to Indonesia, about that pivot to Cambodia. Sorry, folks, but that's not going to help.
Now it's going to cost you.
You know, it's interesting, Katie. The other thing I would add to all this, too, talking about the consumer, you've seen estimates all over the place. You could have anywhere from $1,000 annually to, if you're Larry Summers believes $300,000 could be wiped out from the consumer wallet. The budget lab over at Yale says it'll amount to $3,300 annually per household wiped out annually.
Yeah, and then it gets to this idea, too, of are those retailers in a position where they can pass those costs on? The answer probably is going to be no. And I think a lot of them are going to have to wrestle with that.
Yeah, it'll be fascinating to watch sort of these dynamics we're talking about play out. I will note that the U.S. consumer has surprised to the upside. We'll see, of course, what the pain threshold looks like going forward. Our thanks, of course, to Romain Basak. He is the co-anchor of The Close. A lot of programming coming up later today, and we'll see what the market including The Close.
3
It
p.m.
starts at 3 p.m.
Greifeld for that promo.
I'm really interested to see what the market looks like when Romain comes on air, because I was talking about this sell-off lessening. You have some of those dynamics still at play. The S&P 500 down about 3.5%. A look under the hood if we break it down by sector, mostly in the red, as you can see, but you do have some bright spots, and it's basically what you would expect. Very defensive. Consumer staples is your leader, up 1.4%. Utilities and healthcare also seeing a bit of a bid, but again, we'll just have to see how this trade develops. This is Bloomberg. Welcome back to Open Interest. Let's take a look at the stock market. About 20 minutes into the session, the lessening continues. The pairing continues on the S&P 500. Still down over 3%. Again, we were closer to 4% in the pre-market. We'll have to see how that develops, but it's still the leaders to the downside. Big tech taking the NASDAQ 100 down about 3.8%. I want to get over to some of the individual names. A sea of red behind me. You have NVIDIA, you have Tesla, Apple, what you would expect. Nike, too. We were just talking about the pressure that these retailers are under with Romain Basak, but you have some energy names as well as Robinhood down. Let's try to break it all down now with Odd Lots co-host Joe Weisenthal. He came to set for us. And Joe, I know that heading into today, or yesterday rather, you published 8 thoughts on Liberation
No, just
Day.
This morning. There's just this morning, yeah.
Well, what are your thoughts the morning after?
I think yesterday was one of, if not the most surreal days I can recall in like 15 plus years of covering markets. I think, it's like the first time I recall that an administration went into something with a policy that it knew was going to tank the market, and it just didn't care. And I think that's huge, right? This is a huge moment in American life because we're so used to policymakers, both at the White House or the central bank, at least having some sensitivity to the market. And you could say, like, policy shouldn't be geared towards what the market, like, that's a totally reasonable thing, and yet they tend to be. And this is huge that they're like, well, actually, you know what? We know that everything that we're going to announce is going to hurt the market, and they don't care. I think there's a really big moment.
Well, I'm going to steal a question from Jonathan Farrow, who made the point on surveillance this morning. Does the Fed blink first, or does the White House blink first? And it feels like coming into today or yesterday afternoon, there had still been some price and some hope of a Trump put.
That's exactly right. And I think the Fed is very plausibly going to cut aggressively. And now, as we saw just several minutes ago, there's more cuts being priced in. But the question to my mind is, when you're doing large-scale restructuring of the global economy, your productive capacity shrinks because you don't have, you have less complexity, you have less trade. So those cuts are going to be cutting into an environment of shrinking economic capacity. And so the headroom you get in terms of growth, or the bump you get in growth before inflation picks up again, is likely to be lower than it otherwise would have been.
Right.
So I'm not even sure. I mean,
it's
how much Fed cuts can do.
Right. It's kind of, they could cop, but what does it do? And then the other question I have from you is, I'm trying to wrap my head around this. Help me understand this. So if you're putting these reciprocal tariffs on countries where we've essentially exported cheap labor to, right? The reason these deficits exist is because we've exported the labor and we're bringing back goods at a cheaper cost. It's not a real deficit. Why
it's also, I'll say two things about that. One is, it's even generous to talk about some of these as, quote, reciprocal tariffs, given the methodology that was actually used, which is essentially not even measuring the tariffs. What it does is sort of back into an implied level of restriction from the amount of deficit. But then you think about what we're importing from some of these countries, and you think, well, what are we exactly trying to get back here? And so it's like, okay, you look at Vietnam and Cambodia. Are we trying to get back, sneaker manufacturing? My colleague on the podcast, Tracy, wrote a note this morning about the tariffs on the country of Nauru.
Yeah.
Are we trying to get back phosphates? We actually have way more phosphates here than we have in Nauru that we're not using. Are we trying to bring that back? So it's there are certainly arguments that could be made, particularly in areas that are sort of national security related, high tech related, where it's we have to think about our vulnerability to other countries and so forth, about the fact that we don't produce something here. And the canonical example is semiconductors, which incidentally was exempted from the Taiwan tariff. So even that is sort of funny. But I think what's missing here from a sort of markets econ standpoint is what does that end state actually look like, right? What is the good thing? Because the idea of okay, we're going to have some short-term pain, we're going to have a hit in the market, we're going to restructure, but for something good down the line, a lot of people are probably into that conceptually, but what does that thing actually look like? Because if it's trying to get back textile manufacturing, do we have hundreds of thousands of people who want to work
it
there?
Sort of strikes notes similar to what we were talking about with Stefan Seelig, basically. What is the goal? And that hasn't quite been articulated. To your point, I heard Howard Lutnick talking this morning again about fentanyl. So clearly this is still a drug war in some senses. Joe, we have 30 seconds left with you, but you end your note by talking about American exceptionalism. I know there was a stirring note from Deutsche Bank on dollar.
Stirring note from George Sarvel. No, this has been the question for a while, because the U.S. has outperformed every other asset in the world in a straight line for 15 years. It's changed recently.
I got used to that.
I know, I thought it's you're a fool if you diversify, right? You'd feel dumb if you diversify. And there are so many people all in on the U.S., and now this is the central question that investors are asking.
Although it's crazy, Barclays this morning, even Mike Wilson now questioning the Europe trade that had been taking off this morning. Joe, we thank you so much.
Thanks for having me. Anytime.
Keep the words flowing. We love reading them.
Keep typing away.
That is
I love typing.
Joe Weisenthal, the host of the Odd Lots podcast. Don't miss that as well. Some great content there for you to make sense of what's going on. And coming up in the next hour, we're going to give you Citi strategist David Groman, incoming Allspring CEO Kate Burke, and Olivia Landau of the Clear Cut. Stick with us. This is Open Interest.
We're 30 minutes into the trading day after the big day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today.
Let's get a check on these markets. The S&P 500 down about 3.5%. Tech is leading the charge to the downside here, with the NASDAQ 100 off about 3.8%, off session lows, but still a wipeout and then some. The Russell 2000 not on the screen, but entering a bear market. We do have some economic data to chew on as well. As if there wasn't enough news, we take a look at the ISM Services Index for March, missing, coming in at 50.8. The survey had been for 52.9, and that is versus a prior reading of 53.5. So quite a miss there. Still above 50, but just so. I want to take a look, too, at ISM Services prices paid, also coming in below expectations at 60.9. Expectations had been for 63.1, and you can see that the prior reading was 62.6. So quite a miss there, and you see the reaction in markets. The S&P 500 still down about 3.6%. That bond rally continuing, sending yields lower. But let's get back to our big story, and that is tariffs. As I mentioned, tech is among the sectors that is hardest hit. Let's break it down with Bloomberg Technology co-host Caroline Hyde.
MAGA has come for Mag 7. We are seeing a significant sell-off, the worst on the NASDAQ 100 since 2022. $300 billion alone wiped out of the market capitalization of Apple. We're off by 9% for that name. Extraordinary notes coming from Rosenblatt, for example, saying, quick back-of-the-envelope math, this is going to blow up Apple. They say that they cannot really understand that Trump would want to blow up an American icon, but it looks tough at the moment. Jefferies, for example, saying they think eventually Apple will be exempted, as they were under the previous Trump administration. And actually, you've got the likes of Wedbush saying maybe this is a buying opportunity because this is going to be temporary in nature. However, overall tech spending is going to be on ice. So that sort of downdraft risk aversion is going to slow sales, not just for the hardware giants, and Dell is currently off by almost 20% today, but the software giants. That's why Microsoft is down. Meta, Alphabet maybe get hit by reciprocal nature, the retaliation coming from Europe where they eye a digital services tax hike. That's going to impact their revenue significantly. So across the board, this is just a washout for big tech.
Brutal headline. Apple erasing over $255 billion in value, and on a closing basis, not on an intraday basis, but on a closing basis having the worst day since 2020. That is Caroline Hyde. Now we're also watching the auto sector. They have been responding. They've been already responding to Trump's tariffs with supply chain price changes, and already have taken big hits this year. Nora Melinda is looking at the sector today.
Sonali, I'm seeing red all across my screen as I'm looking at German automakers. I'm looking at Tesla. We've got Stellantis in focus. That's the maker of Jeeps. They're actually already temporarily halting some of their production in Canada and Mexico. We are seeing this as a lot of people are making these big reactions to that news that we got yesterday, less than 24 hours ago. 25% tariffs on autos, and we're seeing shares of these automakers falling, and some big names in Germany, they're actually saying that this will only create more rising inflation for consumers, and it'll also make the price tag on these cars a lot higher. Ford, we also had beginning to offer steep discounts to some of their cars. So we are seeing a rapid response here. It'll be a lot of headlines here to follow, but lots to keep an eye on here this morning, Sonali.
All right, yeah, between April 3rd and June 2nd, Ford offering all buyers the same discount it extends to its employees. That is Nora Melinda with a look at the autos. Let's keep the conversation going and talk about retail. Obviously, a very globalized supply chain, a major focus for investors. Bailey Lipschultz, take us through the damage.
Everything is down, Katie. Nike down more than 13%, trading at the lowest level since 2017. As you can see, stocks like Lululemon and RH under pressure. This coming after the U.S. imposing a 46% tariff rate on Vietnamese goods as part of that, and as well as a 49% on Cambodia and more than 30% on China, Indonesia, and Thailand. The big thing for these companies is that there was an expectation that moving their supply chain out of China would help protect them. That's not the case when you target Vietnam. Looking at some of the data compiled by Bloomberg, Nike brand footwear, 50% sourced from Vietnam, Lululemon 40%, Adidas 39%, and the list goes on. It's a number of question marks for the company. When you look at the weakness we're seeing in RH, when your CEO is on its earnings call and drops an expletive word or two to describe some of the damage, it's really only mounting, especially, again, when you look at a company that caters to the better off and also is sourcing quite a number of goods from overseas. The ripple going on around these supply chains and what it ultimately can mean for consumers if they do feel the pinch in a recession. That's the big concern for investors, and that's why you're seeing them wholesale dumping a number of these companies.
We can only pray that there weren't any children on the RH earnings call. Bloomberg's Bailey Lipschultz, great roundup. And let's keep the conversation going because we've been mentioning autos, tech, also basic resources, most at risk from tariffs. That is the view of Citi strategists who are exploring an extreme hypothetical scenario in which EPS growth for individual sectors in Europe would be cut in half. Joining us now is the man behind that call. His name is David Groman. He is Citi Global Equity Strategist. So, David, correct me if I'm wrong, but I believe that note came out before Liberation Day, before we got the details of Donald Trump's tariff plan. Is the worst case moving closer to the base case now?
Yeah, listen, I think what we were looking at is that maybe something like a 10% tariff was priced into European equities going into Liberation Day. Obviously, we got larger tariffs than that, 20% on the EU. I think it's interesting if you look into the price action in Europe today, really this is becoming about more than just tariffs, and it's about the second order effects and a potential growth slowdown coming here, right? In Europe, it's a mix of properly cyclical sectors that are underperforming, even those that have maybe less direct tariff risk like banks. So, I mean, maybe there's still some hope outstanding that trade negotiations are possible and the like, but we need to be thinking about not only the tariffs themselves, but also maybe those second order knock-on effects going forward.
You know, you think about that bid that had been drawn into European stocks since the beginning of the year, and you're looking at a DAX, for example, that is still up about 9.6%. So it's held up. Even after the tariff announcement, it had been down about 2.6%. You know, is the sell-off more pronounced to come, given the way that these tariffs will be playing out and given the bid that we've seen this year?
Yeah, I think, there's some reasons to still be optimistic, at least in relative terms on the European story, right? I think the European market had been structurally underowned by global investors for quite some time. Obviously, we've seen a meaningful shift in the policy backdrop. And I think you could also make the argument that maybe the growth hit from tariffs does affect the US at least first before it spreads into the rest of the world. And I think if we're in this environment where the US is slowing, but the rest of the world is more resilient, that's ultimately an environment that could still favor Europe. But obviously, right, if we spill into an environment where the US is going into a proper growth slowdown, a proper recession, I think some of these higher beta markets like Europe are going to get caught up, right? If the US has an earnings recession, what we found is that over the past 20 years, Europe almost always has one too, right? So you need to be thinking about, is this just slowdown or is this something worse? And I think that starts to question, how long can these high beta markets continue to outperform?
Yeah, David, forgive me for using a cliche, but the U.S. sneezes, the rest of the world catches a cold, at least as you lay out. That has been the story of earnings. But I want to talk about where you might want to hide out. I mean, you wrote in that note that it's autos, tech, basic resources most at risk here. When you take a look at the sector level of the European equity market, where's the best place to hide out, for lack of a better term?
Yeah, so what our analysis is showing, right, is that if you get a 20% tariff, you probably shave off something like 3% of EPS growth in Europe on the whole, and that's coming down from consensus growth of something like 7%. So you're cutting EPS growth in half. And if you then go ahead and get meaningful slowdowns in GDP growth, I mean, you could see that go to flat to negative, right? So in these risk scenarios where things do get a little bit more, dire, I think that you would be looking at some of these defensive sectors that have less international exposure, right, within the European market. So you're making a little bit of a transition from cyclicals into maybe some of that more defensive and domestic exposure.
You look at companies reacting. It's been less than 24 hours, and yet you do see some significant reactions. Stellantis, for example, halting work in factories in Canada and Mexico, for example, for the coming weeks. David, when you're looking at companies change their plans, they are stopping in their tracks and they're pivoting course. Isn't that going to be expensive?
Yeah, and I think it's something that's difficult, and it's one of those longer-term stories that you need to be thinking about that we've been talking about. When you talk about geopolitical realignment and maybe what it means to shift your supply chains globally, is that over time it makes you more resilient, but at the same time you might face some issues with margins, for instance, over the near term as you make those changes. So you do need to be thinking about not only the short term, but the long term. But obviously the risk here from everything that we've been seeing, right, is that potentially some of the changes that we've seen in consumer confidence, in business confidence, investment decisions that are happening, is that maybe we've gone too far down the line where it's hard to pare this back. And you don't always see recessions coming, and sometimes they come a little bit more suddenly than you would expect. So we need to be looking at this. Are there the signs of that slowdown that we're looking for, or are things ultimately going to hold up?
Well, a topic that keeps coming up on this show is that Europe has had a bit of a wake-up call, maybe in a positive way. I mean, we had Stefan pointing out yesterday that you think about the defense spending that has been freed up in Europe. Neil Dutta made a similar point in his note, writing that the Europeans are actually boosting their defense spending, not something you've seen that often. David, I mean, are there any sort of tradable actions that you can make around those sorts of dynamics?
Yeah, and I think this is the key point with the European story, right, is that something has fundamentally changed, at least for the medium-term picture. So, right, if you look at consensus EPS growth forecasts for Europe out over the next 5 years or so, right, it's something like plus 9% growth per annum that's penciled in. It's probably a little bit too high. It might come down over time. But think about that number. If we use our top-down models and apply in a lot of the fiscal spend and the changes that are coming through, what we would see is that you could see EPS growth rise by about 2 to 3% per annum out over the next 5 years. And if you were to assume some ERP compression as well, I mean, you could see Europe going from a market that has traded historically at a multiple of 14 times up to something like 16 times. And obviously, there will be some volatility along the way. And the risks that we are seeing around tariffs right now are certainly one of them. But I do think there is still that medium-term structural tailwind that might be there from the European story coming from this defense spend, also the fiscal spend on infrastructure that we're seeing out of Germany, which are really meaningful.
David Groman of Citigroup joining us now. And of course, Katie, we know that all of the tariffs are not created equal here. I'm looking at a bump by our deputy editor-in-chief saying that you better buy your Swiss chocolate now because the Swiss are hit harder than the EU as Rolex and Swatch are going to face outsized tariffs.
He would say that, wouldn't he? I think he's a fan of Swiss chocolate. But I mean, clearly a lot of auto buyers had the same idea. You saw that pull forward in the delivery numbers. So clearly consumers trying to get ahead of these tariffs.
We're going to talk more about that, and we're going to talk more about what the Commerce Secretary said, because he said, Howard Lutnick said the U.S. domestic growth will have the greatest resurgence ever under Donald Trump. Part of our conversation with him next. This is Bloomberg.
Donald Trump is focused on the economic pain that the United States of America has suffered over decades. Since NAFTA, 90,000 factories, not jobs, factories, 5 million high-paying jobs gone overseas. He's focused on the U.S. worker and the U.S. economy. And what's going to happen is people are going to realize it is the great American economy that is the winner here. And anyone who doubts it, and anybody who shorts Donald Trump, or anybody who doubts the strength and the power of the American economy is making a foolish bet. Sure, importers are going to have a tough time figuring out what to do because they went and found the cheapest production in the world. It's time to bring that production home, to have the smart, amazing people who run American companies figure it out, bring robotics back to America. And I would say that United States domestic growth is going to have the greatest resurgence ever under Donald Trump, and that's what he has set in motion yesterday.
You'll accept it takes time to engineer a supply-side response, though, sir. And in the meantime, you can see bad things happen. Do you accept that?
Well, what I can accept, of course, it takes time to build factories, but companies understand how to do it. They will do it. The United States of America is the greatest economy in the world. People have to do business with it. The rest of the world will bring down their trade barriers, and you'll see a great resurgence in our ability to sell agriculture overseas. You'll see factories being built here, and that factory production will be faster. So sure, there will be a rebalancing of those who make things in cheap labor markets, figuring out how to make them here. But ultimately speaking, and I think in much less time than you think, the world will reorder itself, will figure it out, and the United States growth rate will turbocharge compared to the rest of the world.
That was Commerce Secretary Howard Lutnick speaking earlier on Bloomberg Television, and that brings us to the Wall Street beat. Joining us now for the economic impact from the tariffs, Bloomberg Chief International Economics and Policy Correspondent Michael McKee, and for the impact on markets across macro markets, Edward Harrison, author of Bloomberg's The Everything Risk newsletter. Now, Mike, I do want to start with the American household because for years we've been asking, when do the pains on Main Street hit Wall Street? And it looks like this might be the moment. If you look at Yale's estimates at the Budget Lab, you have them seeing an average household being hit by $3,800 annually. And that's just one estimate. These estimates are all over the place. At what point are you facing an American economy that either can't spend money or face even a recession?
No. Basically, I mean, we're not getting a lot of specific calls yet because people are still working their way through all of this. It's obviously very complicated, but basically we're looking at an average weighted tariff, according to the notes I've gotten this morning, between 18 and 33%. By comparison, Smoot-Hawley was 20%. So it's a huge difference. Fed model 2018, when they did the tariffs, they thought that would cost GDP 2.3% and prices 1.5% higher. Probably all of that is going to be incorporated into models for this year. So it leaves the American people much worse off. As you note, the tariffs are going to cost, we pay, this is a tax. We're going to pay, according to the notes in today, somewhere between $400 and $800 billion in additional taxes here, which means it works out, if you divide it up by the weight, about $1,500 per person. You were talking about per family, per person. And that's going to hit even harder at the lower income levels. So it does set us up for a real retrenchment when people start to think, I'm not going to have the money to deal with this.
Right. Yeah. I mean, you take a look at J.P. Morgan's Michael Feroli saying that this plan is equivalent to the largest tax increase since 1968. You had UBS economists saying that real GDP could be hit by 1.5 to 2 percentage points in 2025. And I want to come to you on the market reaction because we've seen a big sell-off, obviously, in the equity market. The S&P 500 down about 4%. The bond market, 10-year Treasury yields, 4 is a recurring number here because 10-year yields broke below 4% briefly just a little while ago. The view of Ian Lingen over at BMO Capital Markets was basically that bond market sentiment here is going to follow stock market sentiment. If stocks continue to slide, you'll continue to see bond yields slide. Is that your view as well?
Yeah, that is a risk. The real question is this trade-off because, you know, this is what you would call stagflationary policy between the two mandates that the Fed has. So the expectation is that it will slow GDP growth and the tariffs will also, you know, slow the labor market. The question is, what happens to inflation? If inflation increases enough that the Fed can't look through it, then what we're seeing in the bond market today is going to be backed out at some point in the future. What we've seen today is, you know, a pricing in of 50% of a fourth cut in 2025. You're only going to get that kind of cut if the Fed sees extreme weakness in the labor market and also the inflation numbers are low enough that they can look through them thinking that this is a one-time price step up. But if we get something north of 3% already, even before the tariffs come into play, you know, the Fed's hands are going to be tied, and you will see the bond market move in the same direction as the equity market.
Ed, when you take that 50% chance of 4 cuts, you think about Renaissance Macro. Neil Dutta was one of the people making that call. Mike, how much room does the Fed have, particularly if you see inflation? Because you're hearing people start to say stagflation more and more and worry about that.
Stagflation is a real problem for them because if the economy is slowing, you want to cut rates and boost growth. If the economy is seeing inflation rise, you want to raise rates and choke off inflation. And if you're somewhere in the middle, it's really hard to deal with. Right now, I think the Fed is just going to sit tight for a little bit and see how this plays into the economy overall and see how bad we see growth go down. If growth doesn't go really bad, if people sort of hang in there, then they can leave rates where they are now to keep inflation from rising as they're doing their current policy. But they might be forced into a situation where they need to cut rates, and that's going to give them an inflation worry.
All right, guys, great roundtable. Really appreciate both of your insights. Our big thanks to Bloomberg's Michael McKee and Edward Harrison. And for the latest news and analysis on Trump's global tariff rollout, check out our live blog at TLIV Go on your Bloomberg terminal. This is Open Interest. Welcome back to Open Interest. Let's get a check on these markets right now. That sell-off deepening once again. The S&P 500 down by more than 4%. A lot of that pain coming out of the tech sector. You have more than 400 names in the red right now. It's led by the likes of Apple, Amazon, Nvidia, Meta. The list goes on. I want to highlight volume here, trading volume off the charts right now, but I believe we actually can chart it. You're taking a look. That white line is where we are. We're just about 1 hour. Forgive me, into the trade. That is the projected volume right now for where we're going to finish up. Right now, at this moment, though, we are 70% above the 30-day trading volume. So clearly, this is a very, very active market, Sonali. Traders selling in to this drawdown.
The question I have is, if you look at some of the trades that we do see today, you have to wonder if some of them look pretty crowded. The discretionary trade, the bond market, if any of those were to reverse, how much dry powder is there to be had if we do see those lows that Mike Wilson was talking about? You said 4,700 on a 200-day that we're watching?
200 weekly average.
Weekly, right.
That is the 200-week average. That is the level that Mike Wilson is watching. And coming up next, we're going to take the pulse of the asset management industry with Kate Burke. She is the new CEO of Allspring. She joins us exclusively next.
Let's get a check on these markets because we are looking at markets S&P 500 near but off of session lows at 3.8%, almost 3.9% lower. Looking at the NASDAQ 100 taking even more pain, down more than 4.2%. That 10-year yield, it had briefly fallen below that 4% level, now back to about 4.03. We will keep an eye on it throughout the show and, of course, throughout the trading day. Traders really feeling the pain from those tariffs. But now we are going to bring in Allspring Global Investments' new CEO. She is joining us here for an exclusive interview. Kate Burke is taking over from Joe Sullivan on July 1st after serving as president for the past 2 years. Allspring is a global asset management firm with $605 billion in assets under advisement. Kate joins us now. A day like today, taking over a new role. I mean, how do you address clients in what is really not only a volatile market, but a changing paradigm for investors?
I think it's really important to remember that clients and asset managers have lived through volatility in the markets before. And what is most important is to look for opportunities when you see this kind of dislocation and stay the course. So ultimately, as long-term investors, you want to be able to respond in your portfolio and make adjustments when you see something like this happening, whether it's in your fixed income portfolio or where you're overweight in equities. But ultimately, getting the timing of the market and understanding how and when these tariffs will play through is going to take some time. So knee-jerk reaction, quick responses. We are fundamental investors. We're going to continue to do the deep research, look for those opportunities, and work with our clients so that they're well positioned in a variety of different outcomes.
Yeah, it's an interesting question. I mean, and Kate makes the great point that we have seen periods of volatility. Some folks would venture that, I mean, we're starting to toss around terms like stagflation. We haven't really dealt with that since the 1970s, so it's been a while. But that volatility coming through in markets right now, I know you've been watching the VIX. The VIX right now is certainly popping.
It's incredible because we saw that 20 level be something that, say, the likes of the New York Stock Exchange was concerned about stifling capital markets activity. Now, what does this mean in terms of the types of assets that investors will be looking for? You said fixed income, for example. Does it mean you lean in to diversification?
I think leaning into diversification absolutely makes sense, and that's when I'm talking about making modest adjustments. You may choose to look and move a little bit more into fixed income at this point, looking at your core portfolio, taking advantage of some of the stability that we'll ultimately think that we'll get in the bond market as you wait out some of the volatility that we're seeing in equities. But even then, you have to be careful because ultimately the credits of many of these companies are going to be also impacted by these tariffs. Right. And so understanding how that plays through is, again, why fundamental research, I think, is so important in this type of market. Because while you can have this big macro impact that's happening really across the globe right now as we await responses from different countries in terms of what they will do in reaction to this, there's going to be a lot of new information coming. And having fundamental analysts and portfolio managers looking at the fundamentals of those companies, understanding what their supply chains look like, where will that impact happen, right. and then looking for those opportunities. There will be, in times of dislocation, there's always opportunities to get into great companies whose valuations may have been high, and now you have this opportunity from a long-term investment to take advantage of that and add to your positions there.
So I hear the case for active management coming in strong there. Before we get too much into asset classes, I actually want to take a global perspective right now, because the conversation we've been having really for the past several weeks at this point has been American exceptionalism. You think about these tariffs, you look at the reaction in markets, and you have to wonder, I mean, is the case for investing in the U.S. weakening right now?
Well, I think that the question of how these tariffs will play out globally is still unknown. You certainly have seen reports of people saying you should be looking more, that this might be an opportunity where Europe, where it has not outperformed in some period of time, that there could be a window where you see that. But they're also going to be impacted by the tariffs. And so I think the question we're really facing is what is it going to do for the global economy? This is not going to be limited to impacting the U.S. economy, but much more broad in its impact. And understanding, again, where those supply chains, where you're going to see the disconnect between the tariffs, where you're going to see different consumer behavior as an outcome of this. Certainly prices are going to go up across the globe as a result of this, and that means consumer demand is likely going to be impacted. So we do have concerns that you're going to see a slowdown in not only the U.S. economy, but the global economy as well.
Yeah, and that rush that we've seen into European markets could be running into some pretty tough, hard data over the next several months. I want to talk, too, about how you're meeting investors and how you're sort of, giving them that access. I know that Allspring recently launched a lineup of ETFs, for example. I cover the space closely. When you think about the demand for different vehicles, where does it lead you?
So at Allspring, our goal is to be vehicle agnostic. We think whether it's the mutual fund, the ETF, or a separately managed account, the wrapper is really the decision of the investor and understanding their positioning, what are their views on taxes and the impact of that in their portfolio. So I think the wrapper is a tool to get to clients and give them client choice. The investment decisions, the investment strategies that you're looking at are really what we believe are at Allspring. We provide the foundational building blocks of any good asset management strategy. So whether you're looking at core fixed income, core equities, growth or value equities, munis, we provide that to you, and our goal is to give it to you in the wrapper that is most appropriate for you in your personal situation. So I expect us to continue to do more in the ETF space. I expect the ETF space to continue to grow.
That's good for my job security.
Well, I'm happy to hear that. It's still small in terms of its overall size versus mutual funds and separately managed accounts. So I think there's tremendous opportunity for the ETF market to continue to be a growing vehicle.
Kate, congratulations on the new role. Of course, that is Kate Burke. She is the incoming Allspring CEO. Now, I want to bring you some breaking news as well, because we are watching the fallout from Trump's tariff announcements. And now we have France's Emmanuel Macron urging companies to pause U.S. investments. He's speaking to industry groups affected by the tariffs. Of course, this is just one of the countries we're watching out of many. And even before the tariff announcements, Katie, we had heard from other regions, like, for example, in China, where they have already taken moves to limit the amount of money coming into the United States after these levies.
From Germany as well, and we know that Macron had believed that the European Union should be ready to respond with options such as targeting U.S. tech and services. That had been our reporting, and now we've gotten the confirmation. You take a look at what the currencies are doing in response. I'm looking at Euro USD, that pair not responding too much, but already we'd seen the reaction. Euro USD, the euro stronger by about 2.4% against the dollar right now. That pair trading at 1.11 thereabouts. So we'll continue to monitor that story. But let's take a look at what's moving in the U.S. equity market and get to the single stock level now with Bloomberg's Isabel Lee.
Hey, Katie, we're looking at Nike. Shares are edging lower by 13%. That's the lowest since 2017. So we have Nike increasing the reliance on factories like Vietnam and Indonesia, and that's after President Trump imposed tariffs in China in his first term. And now Nike produces 50% of their goods in Vietnam. And yesterday we saw that Vietnam was imposed with a 46% reciprocal tariffs and 32% on Indonesia. So these companies will really struggle to find a place for their production, and it's either they will absorb the cost or they will be passed on to consumers. Next, we're looking at Apple shares. This is also looking bad because shares are edging lower by nearly 9%. It's pared back some of those gains, just 8% now, at erasing $255 billion in market value. So even after the company's years-long effort into insulating itself from trade wars and supply chain disruptions, they're still really hammered. Apple, their supply chain is largely in China, and that's really affected because China tariffs will reach 34%. That will bring the total rate on Chinese goods to around 54%. And the thing is, tariffs also cover Apple's other manufacturing areas. For instance, India is where they build iPhones and AirPods, and Vietnam is where they make some AirPods, iPads, and Apple Watches. And lastly, Stellantis. This is also not looking good. We know that President Trump's decision to impose 25% tariffs on autos goes into effect Thursday. And we have Stellantis planning to temporarily halt their production in Canada and Mexico. So this is the first concrete effects of the tariff. It's unclear how long they will pause their Mexico operations, but at least for the Canadian one, it's going to be 2 weeks beginning Monday. Back to you, Katie.
Isabel, we thank you so very much for looking under the hood. Now coming up, we're going to take a look at the tariff impact on the jewelry business. Olivia Landau, founder and CEO of The Clear Cut, joins us on how her firm will be impacted next. This is Bloomberg Open Interest.
Welcome back to Open Interest. To check on these markets right now, that sell-off deepening in the S&P 500, now down more than 4%, 4.1% if you want to be exact. A lot of the pain coming from big tech, and you can see the bond market catching a bid as well. Things are actually looking okay. Losses were lessening, and then we got that ISM Services Index coming in below expectations at the top of the hour. Just another hit to sentiment as we continue to digest what we learned from President Donald Trump last night. And those new tariffs will impact businesses big and small. Let's hear a bit from the small business side of the picture, because joining us now is Olivia Landau. She is the Clear Cut founder and CEO. The Clear Cut is the largest digitally native, only natural diamond jewelry company in the U.S. Olivia, it's great to see you in person.
Thank you so much for having me today.
So we're all trying to make sense of the tariffs and talk about the economic fallout. From where you're sitting, where does it impact your business when you think about your supply chain and where you actually source your diamonds from?
Yeah, so for us, we're unusual because we make all of our jewelry in the U.S., in New York, which many of our competitors do not. So in that regard, we're not too worried. But in terms of the diamonds, it's still really uncertain what's going to happen with the tariffs. We're having our eye on India, where most diamonds are manufactured and polished. But what we have seen is from the tariffs, the price of gold has gone up, and that's going to affect most jewelers in terms of their cost of goods, and now really wanting to pass that along to their customers. So that's the most immediate impact that we're seeing right now.
You know, it's interesting. We were looking at the price of gold just consistently being bid up, and it does bring me to the next point. Not only gold, but just materials as well. Even if you're manufacturing here, how worried are you about the things that go into all that jewelry?
Yeah, it is a concern, and there's so much uncertainty around it. So I think we're just waiting to see how it's all going to unfold.
Yeah, it feels like a lot of companies and investors are in wait-and-see mode right now. But I want to talk about the other side of the equation, and that is folks buying your jewelry,
Right.
what consumer demand looks like. I mean, where is your average consumer actually located?
So most of our customers are throughout the U.S., but we do have internationally, mostly in the U.K. and Canada customers. And tariffs have always affected those customers because in UK and Canada, I think it's a little above like 20% for the import VAT. So that does affect our sales internationally.
You know, when it comes down to the push-pull between what is happening in the Trump administration, we're looking at the tariff side of the story, but very soon we'll be looking at the tax side of things as well. When you're looking to Congress, looking to pass all these measures on tax, how much do you need it to be able to be successful as a small business in this country?
I mean, taxes and tariffs really, really affect small businesses. For us, it's a huge consideration with our clients because we do sell higher value products. So every small percent makes a huge difference.
I do want to get a little bit into a very fierce debate in the industry because, as I mentioned, you're natural only. We've seen a real surge in demand for lab-grown diamonds, especially from the younger generations out there. I think Sonali and I are both wearing natural diamonds right now, but you've seen a lot of Gen Z folks who are getting engaged, gravitating towards those lab-grown diamonds. How do you appeal to that younger audience who seems to be shying away from natural?
So I think the rise of lab-grown diamonds there were a lot of things that came into play, mainly a lot of greed and misinformation, as well as high price points for natural diamonds post-COVID. So it was the perfect storm. You know, you had jewelers that could finally make super high margins, over 2,000% margins on lab-grown diamonds versus 10 to 30% on a natural. With the same time, you could say they were more ethical, more sustainable, and the exact same thing. So I think now, actually, as natural diamond pricing is softening, we're seeing a big shift, at least in bridal and more investment pieces, back to natural with the Gen Z. We just had our best quarter since 2022 and the highest average order value in our history.
Olivia, we thank you so very much for joining us today. That is Olivia Landau of The Clear Cut. Now, coming up, tariff announcements continuing to hit tech stocks hard. We're going to get a deeper dive into that sector next. This is Open Interest.
Welcome back to Open Interest. We're taking pulse of this sell-off right now. The S&P 500 deepening even more, that drawdown, now down 4.4%. Let's tell you why, and let's take a look at the sectors. A really interesting picture that we have on our hands. Almost every single sector is in the red right now, but if you take a look at what is actually performing well, it's what you would expect. It's consumer staples. You actually have Lamb Weston. You have Kroger, for example, rallying hard today, a defensive play at hand. Utilities seeing some of that action, but not quite as much as consumer staples. But Sonali, take a look at the bottom. It's as we've been talking about. You have technology down in a big way, consumer discretionary even more, but we know that that sector is dominated by Amazon and by Tesla.
Absolutely. We're going to talk about those tech stocks now, getting hit hard by the tariff announcements. Joining us now for more, Mandeep Singh. He's Bloomberg Intelligence Senior Analyst. We have been talking for months now about how the tariffs could have very significant impacts. We're talking about parts, but we're also talking about reactions from the likes of China. What about Taiwan? How do you see this ultimately playing out?
I mean, look, when it comes to tech companies, on the revenue side, we know tech companies have the most international exposure when you compare it to all the other sectors that you just showed. What we don't know right now is how the other countries will react. because if these companies are exposed internationally and other companies impose tariffs on top of that, like for Meta or for Alphabet, anything that happens in Europe will have a bearing, even though they're not really selling a product like a hardware product,
right?
Because that will have a bearing on their revenue. So right now, the impact is more visible on the cost side for companies that are making products. Like Apple is the most obvious one because clearly Taiwan, China, that's where all their supply chain is, all the hardware server makers, they're exposed on the cost side. The revenue side is where there's still uncertainty. How are those countries going to react?
Yeah, you're right. We've been focusing on hardware because that's what's getting hit the hardest. That has been obviously the knee-jerk reaction to what we learned yesterday afternoon. But you had a note heading into the tariff announcement that I thought was really interesting. You write that tariffs are likely to drag on social media. A little bit unintuitive. What is the logic there?
Well, so think of what is discretionary now. If companies have to pay more in terms of costs, for tariffs, then what are they going to pare back on? They're going to pare back on digital ads. And we know, Chinese advertisers like Temu and Shein, they spend almost $10 billion in digital ads on Meta and Alphabet and these social media platforms. So they're going to pare back in a big way because obviously they can't sell anything at the cost price. So I think you're going to see that trickle-down effect in terms of discretionary software spend getting pulled back, discretionary ad spend getting pulled back, and that's where it's going to trickle down to other companies.
So maybe I'll encounter less ads when I'm scrolling furiously on TikTok.
Well, that is the hope.
Yeah.
But speaking of less ads, you're worried about a consumer. You have certain companies, Apple, Amazon, very exposed to the consumer. But what about the B2B companies or B2B products? If you're Microsoft or if you're Google and you're thinking about your cloud customers or anything like that, is there immunity or is there just as much pain that investors are not seeing?
Yeah, well, now we'll find out which those really non-discretionary software spending items are, because companies clearly, I think, cannot run without internet and, Microsoft Office and these kind of products, which are really non-discretionary. But anything discretionary, we'll find out what gets cut in the guidance in 1Q and 2Q, because if these tariffs remain, you will see the trickle-down effects, and it's going to come fast.
Well, speaking of Microsoft, this story has gotten a little bit lost in the sauce because we've been so focused on tariffs, but our Bloomberg News team breaking the news that Microsoft is pulling back on data centers. They've halted or delayed data center projects in several locations: Indonesia, the UK, Australia, Illinois, the list goes on. We've been so worried about CapEx spending. This isn't the conversation that we're having today, but I have to imagine it's going to re-enter the lexicon.
Absolutely, and it's discretionary items for a company like Microsoft. Do they really need to spend $85 billion in CapEx, or can they do with $50 billion now, given all the uncertainties that are out there? So everyone right now is looking at what is essential versus what is discretionary, and then how to obviously mitigate the impact of tariffs. So I think the product guys are the ones who are really put in spot right now. But eventually, when it trickles to revenue impact, that's when you will see more far-reaching impact here.
Yeah, well, that calculus is happening on the part of businesses, but consumers as well. Mandeep Singh, great to see you. That is Mandeep Singh of Bloomberg Intelligence. And Sonali, take a quick look at these markets right now. It looks like investors, traders are deciding actually nothing is essential. Let's just sell everything.
Some of the stock moves that I'm seeing, I'm looking at JP Morgan, Fortress Diamond, okay? The stock is down more than 7.2% at the moment, too. So just as much pain in the financials. I will point out that earnings season starts next Friday, so you're going to hear the numbers right away.
Yeah, there you have it. But before we get to bank earnings season, we have Jobs Day to get through. And coming up tomorrow on Open Interest on Jobs Day, I'm pleased to say that we're joined by Rick Reeder of BlackRock, former Fed economist Claudia Sahm, Jed Laskowitz of JP Morgan Asset Management. The list goes on. This is Open Interest.